Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, Scott, welcome to another episode of the AWA Market Minute. How you been?
Doing well. It's amazing how fast these months go by, Paul. We're already more than halfway through spring. Pretty wild.
Yeah. Well, and for the first time all winter, it feels like winter might be showing up, which is always fun.
It's been upside down. Paul, here in Utah, we've seen like no winter, and it was, 70 degrees in, February type stuff. And now we're getting snow here in late April. So go figure, right?
We were in February playing pickleball outside, and everyone kind of got a little too comfortable with it. And a lot of people started canceling their indoor memberships. And this week, everyone's like, we got to go back indoors again. It's getting too cold and rainy and windy and even got some snow last week. So, we're getting it a little late this year.
For sure.
Well, on top of all that, Scott, this last month has been very chaotic, but not so much from the weather perspective, but, a lot going on in the markets. So we got a war. We've got many other major geopolitical events, and we're starting to have conversations about midterm elections. And so it's a lot going on with a mixed bag of economic data. One of the things I wanted to start with this month's market call is just all of this barragement of information is there a worry, Scott, that investors today are being forced into paying too much attention to short-term noise?
Absolutely. Yeah. There's the old adage, and we've talked about this before in this format. If it bleeds, it leads, right? If it's negative news or sensational news, like that's the stuff that's consuming the headlines. And so people just get inundated with hyperbolic stuff, and it's hard for them to know what's important, what's not important, and they just have a deluge of information that's hard to digest. And sometimes people are frankly better served by consuming less of it.
Yeah. No, I think that's good perspective. Nonetheless, we're going to disregard that good counsel. We're going to dive into some of the noise today.
We're going to enter the fray, and we're going to contribute to the problem, Paul.
We're going to try to make sense out of the problem. But you're right. In some regard, we'll give you guys 30 minutes a month of information. Our goal, obviously, is to try to digest it in such a way that is consumable and applicable, right? So there's some sense to it. So Scott, let's dive in with the Middle East. It's obviously dominating headlines today. From your perspective, what actually matters here from a market standpoint versus what's just noise?
Yeah. So a couple of things. So the primary and immediate one is the opening of the Strait of Hormuz, and this isn't news to anybody who's been following it. Global energy supplies have been really constricted by the closure of the Strait of Hormuz, and so the quicker that gets opened, the less the economic damage. And we're feeling a little bit of that here in the United States, but other places like Asia in particular, where most of the energy comes from there, countries like Japan, South Korea, Southeast Asia, etc., they are really feeling the pinch by having that energy supply slowing to a trickle. So that's super important. And then the ultimate fate of the Iranian regime is important. Jamie Dimon, who's the CEO of JP Morgan, has talked about, hey, if the kind of malice and disruption that the Iranian regime causes, if that were to go away, the chessboard of the Middle East looks very different, and the potential for economic growth and everything is quite a bit higher. And all things being equal, world economic growth does a little bit better with that regime out of play. So I think those are the two big items, and then there's a million ancillary ones of varying importance that are out there as well.
Well, let's dissect the first one a little bit better. How does something like a disruption in energy supply actually work its way into markets and portfolios of our clients?
Yeah, and it's a great question, and this is where duration becomes super important. So, in the near term, what happens is energy prices go higher. To the extent there aren't stores of fuel and other things, prices go up immediately. Some, airlines and other people will buy futures contracts and not have as much exposure in the near term to some of that, so it takes a while to hit. But that's kind of the first impact, is in energy prices directly. But then further down the line, energy is the input to any kind of manufacturing that happens. And to the extent that input is more restricted or more expensive, that results in a couple of things. One, kind of supply shortages, and two, price increases. And so it almost has like a stagflationary impact, where it slows economic growth the longer it's in place, and then it also causes potential inflation the longer it's in place. So in the near term, you see the price at the pump, if you will, spike up, but later down the road, you see the impact to the prices of goods and service and slowing economic growth. And that's why it's so key to get this wrapped up in fairly short order.
Well, and what's interesting about this, Scott, is what you just described is obviously pretty scary. But in spite of that, right now, markets haven't reacted as dramatically as people might expect. So this is a chart of kind of the major indices of the stock market. Why do you think we're seeing this kind of performance, year to date, in spite of kind of some of those concerns we just highlighted?
Yeah, it's interesting, and I'll kind of dive into this a little bit. Markets, Warren Buffett would characterize markets as being, somewhat manic, right? Like not always rationally behaving. And when things are going poorly, the sky is falling, and markets just sell and sell and sell. Good news is just shrugged off, and they tend to sell and sell and sell. Flip side of that, when there's a lot of kind of embedded optimism in markets, they just buy and buy and buy in spite of economic data to the contrary. And that's, I think, what we're seeing right now. There's just embedded optimism that the rosiest case is going to play out with this, that the war will come to a pretty tidy and quick conclusion, that economic growth is going to resume at a pretty rapid rate, and that there's a lot of pent-up demand that's just going to go crazy. And so the market's heavily betting on that outcome. To the extent that outcome's not realized, that's where it could be setting itself up for disappointment.
So that's the big risk in being overly optimistic, is a very disappointed, unmet expectation and reality setting in to almost the opposite of optimism, right? Where now it's like, hey, the sky is falling, and to your point, markets being manic. I will say, interestingly, S&P here, kind of a general indicator of the market as a whole in theory. NASDAQ here and Dow here, that's a pretty big gap between the NASDAQ and the Dow. Explanation there?
Yeah, so the NASDAQ, as we know, is more technology heavy, and so there's going to be more focus on kind of growth companies and technology companies. And then while the Dow increasingly has some exposure to those kind of industries, it also has more of kind of what we deem industrial and more diversified exposure. And so with the kind of post ceasefire rally we've seen kind of the technology side outpace dividend paying stocks and other things. And I think the attribution there is there's a lot of optimism still and a lot of bullishness around AI and technology and growth generally. And that's why it's up quite a bit more.
Okay. So more technology focus, and obviously that's been more volatile. So we've seen a little more growth there.
Yeah,
that makes sense. So Scott, let's shift to elections. This is where emotions really start to come into play. We're about 6 months out from midterms. What are you seeing in the data right now?
Yeah. And as we dive into this, Paul, I think that's an important caveat. 6 months is both a short amount of time and a long amount of time, right? As far as the news cycle and the things that can, kind of come about in 6 months, there's a lot that can happen over a 6 month time period. But that being said, it is going to be November before we know it. And so,
Yeah.
what the data is showing, looking at a couple of the metrics here, the president's approval rating started north of 50%, and then has gradually and in some cases fairly sharply decreased, and is not unusual for a president to have kind of this phenomenon where there's a lot of optimism and kind of positivity with the changing of the guard, and then when reality sets in, there's disappointment that ensues. And so this pattern isn't unusual. What's maybe a little bit unusual with this one is his starting point. His starting point was relatively low, and when it's already a relatively low starting point and has fallen fairly precipitously, not in a great spot from an approval rating, and then that does spill over into the midterm elections and kind of overall sentiment. And we see that kind of in the correct congressional data as well, where the generic ballot, so not an actual candidate, but a hypothetical candidate, polling data says the Democrats are at about 47.5%, Republicans at about 41.9%. So there is a spread there where, all things being equal, Democrats, win more toss-up seats than not, is how that's trending. And this is a, important kind of thing to watch that's maybe has less attention paid to it because the war is so front and center. And we're seeing both parties really jockey in a big spot, in a big way, for every advantage. We had, President Trump with the gerrymandering accusations in Texas, and then more recently, the gerrymandering accusations in Virginia on the Democratic side. And so both parties are, kind of putting everything out there they can to jockey for position and gain, in the Democrats' case, control again of the House, and for the Republicans to retain control.
Well, I guess let's talk about how this, applies specifically to investors. Historically, how much do elections actually impact markets versus how much investors might attribute the elections to the markets?
Yeah, the answer is a lot less than maybe the average voter, the average investor thinks. The political composition often doesn't have as much influence on actual market outcomes as one would expect. And then you mentioned an important word there, Paul, and that's attribution. And I think, politicians being politicians, they will take credit for everything great that happens while they're in power, and then anything bad that happens while they're in power is a result of something of their predecessor did.
They inherited that problem.
They did, yeah. So this is like kind of politics 101, and we see a lot of that. And so it's really hard to say, hey, policy A happened, and by extension, markets did great or did poorly, because there's a lot of other stuff going on, and electoral outcomes and policy is but one of many, many variables, and has maybe a lighter weighting in the overall output than what maybe people think.
Yeah, and I think it's interesting because, obviously, this becomes such an important part of our lives. But man, people, they overreact a lot when it comes to the politics and how they might make an investment decision around kind of political outcomes. And I just think there's a lot of emotion behind that. And generally speaking, you can kind of check the emotion at the door when you want to make an informed investment decision. You've mentioned before that markets can perform well under a variety of political outcomes. So, I mean, for example, here's a slide that we've referenced in the past. Do you feel like, this could be the case, once again, if we do see a significant shift in November?
I think so. In November, in all likelihood, at this point in time, the Democrats will take control of the House. That seems likely. The Senate's a bit more of a toss-up. The Republicans have more seats up for grabs, but a lot of those seats are relatively secure. So the Senate may be a little closer. And we could be looking at the scenario where, if you look under Republican president and divided government, that historically has been a pretty good combination from a performance perspective as far as markets go. The one that's been kind of interestingly the worst outcome is when we have a fully democratically controlled Congress, both the House and the Senate, and then a Republican president. And there's a variety of things I think we could unpack as far as thinking about that. But I think at the end of the day, I don't know that I would read too much into this, just because the overwhelming amount of data says, hey, regardless of the combination, markets can do well under a variety of different regimes, and things like corporate earnings and economic growth and kind of what's going on in the rest of the world. All of those things often play a bigger role than who's occupying the White House or who's occupying Congress.
This might be one of those moments where we return to kind of our opening statement, where it's like maybe taking in less information here, or disassociating that information from your actions in your actual portfolio might be a good thing.
Yeah, and I think an important thing to note here, Paul, is there's a delineation between kind of the cultural and kind of policy impacts of electoral outcomes, and then the actual economic outcomes. And the cultural and political outcomes are very real, and elicit strong emotions. And I don't want to be dismissive of that at all, because that is a material thing, and people legitimately and appropriately worry about those things. But all that being said, the economic stuff that happens is often fairly delineated from that. And so as investors, we need to, as you said, kind of check some of that emotion at the door, and then objectively look, hey, economically, how is this really going to impact me?
No, that's well said. I don't want to dismiss the reality of how policy impacts people, specifically in their lives, and their families' lives, and their work lives. But just maybe understanding that the way the markets tend to work may not have as significant of an impact as we feel emotionally.
Yep.
So well said, Scott. Well, let's talk a little bit about the economy as a whole. Depending on what you read, things are either going great or falling off of a cliff. So if you were to describe the economy kind of in plain English today, how would you describe that?
Yeah, so the economy is doing well, but it's definitely punching below its weight, and even well's maybe a little bit of a stretch. I would say it's more doing well to okay, but it is performing below what it's capable of. The U.S. economy is like a gold medalist type Olympic athlete, year in and year out, and right now we're kind of getting bronze medals, and hey, bronze medals are great, but the U.S. is capable of gold medals. And so I think that delta is maybe, what's interesting to watch right now.
Yeah. Maybe we're not reaching expectations there. So let's start with growth. What are you seeing in GDP and overall economic momentum?
Yeah, it seems like we're seeing a bit of a slowdown. It doesn't appear that like a recession is necessarily in the offing, but we have seen a slowdown. This chart we're looking at right now is called GDP Now, and the Atlanta Fed publishes this, and this is a real-time estimate. If we were to kind of freeze frame everything that's going on, where the economy's at a point in time, and if we look at kind of the most recent print, that's about 1.3%. For perspective, for the U.S., we'd love to see economic growth kind of 3 to 4% range would be amazing. And we were near those levels, a quarter or two ago. And so it does appear that we're seeing a bit of a slowdown. And again, not recessionary, but also not as high as we'd like to see it.
Yeah. So, important to know, like you mentioned, we'd love to see 3 to 4%. That would be kind of that gold medal standard. This is obviously a small sample size of what the estimation would look like, but it is demonstrating, as of this small sample size, we're not quite meeting expectations there. So I guess the question is, are we slowing down? Are we stabilizing? Are we something in between?
Yeah, I would say more slowing down, and again, we're not like careening off a cliff slowing down, but I think we're slowing down a little bit. And if we look at kind of that Q3 print, that was a particularly high point. There was some nuance with that, but it was high nonetheless. And the one to kind of end the year was more like 0.5% economic growth. So that one was more modest, to be sure, and indicative of some slowing. We'll get kind of the Q1 data in the not too distant future, and that's where kind of the trend will be interesting to observe. But my suspicion is it'll be kind of modest, right? It's not going to be wow, that was a really horrible quarter, but probably not, hey, that was a knock your socks off quarter either. And it'll be interesting too. The tail end of the first quarter has the war embedded in it, and it'll be interesting to see how that plays out in the data as well.
Well, let's shift gears, talk a little about inflation. I mean, that's what you're feeling every day. We hear people obviously frustrated at the gas pump. We hear people still frustrated even at Costco or the price of bread, milk, and eggs. Where are we today? Why does it still feel like things are very expensive, even though inflation in theory has started to come down?
Yeah, no, great question, Paul. And this is a interesting kind of discussion, and this is where semantics is important. So when we say inflation is going down, that doesn't mean prices are going down. It means they're going up less fast than they previously were. So the average good or service is 25% higher today than what it was 5 years ago. And so if you're going to Costco, if you're going out to eat, if you're going on vacation, if you're buying insurance for your vehicle, what have you, the average kind of out the door for that is 25% higher, and that's not going to go away. That's not going to revert to what it was previously. And so the most recent data we see shows inflation up about 3.3% kind of year over year. That's still higher than kind of the central bankers want it to be. They want it to be closer to 2%. So inflation is still elevated. And so we're feeling both the pain of legacy inflation that's made everything feel a lot more expensive. And then each year we're seeing increases to the tune of 3+%. So we're definitely all feeling the pain from an inflation perspective. And to the extent there's energy shortages, that potentially is inflationary. To the extent there's tariff impacts, that's potentially inflationary as well. So we track this carefully, but inflation bottom line is higher than what we'd like to see it at.
And I think that's a great maybe takeaway, Scott, is the concept of inflation, is being kind of starting to be kept under control, and then people kind of get this like contradictory sentiment where they're like, I don't feel that way. I think the danger here is we anchor to something from 10 years ago. We look at real estate prices from 5, 6, 10 years ago, and we say, well, we're not there yet. And the reality is this is a really hard pill to swallow, and we never will be. We're never going to go back in time. You're not going to buy a pack of gum for a nickel ever again. You're not going to go to the movie ticket or the movie theater with your date and buy 2 tickets for $5 ever again. So when we talk about inflation getting under control, we're not saying we're going to go back in time to where pricing used to be. That ship has sailed. We're talking about saying the price of these goods and services will continue to expand, but just not as fast as they did last decade.
Yeah. No, and anecdotally, Paul, I'm going to age myself a little bit with this, but I was, in high school in the, early to mid 90s. And I remember a point in time where gas hit 79.9 cents a gallon. Right. And
I remember.
That's never going to happen again. That's not going to be in anybody's future. So as consumers, I think we're just all adjusting to a new normal, and it's not unique to our generation. It's just a function of economic life.
Well, I think this is an interesting kind of way to segue into something beyond the headlines. You've highlighted some bigger long-term trends, and let's start with AI. There's a lot of hype here, but also a lot of real investment kind of happening in this space. How significant is this kind of the advent of AI from an economic and investment standpoint?
Yeah. You and I have talked about this, Paul, and I think we both feel that it is a transformational technology, kind of akin to the railroad back in the day, or when the internet came about, where it's going to fundamentally impact how businesses operate. It's going to fundamentally impact how we interact with each other, and it's going to potentially lead to pretty big productivity gains over time. And some of the economic headwinds or challenges that we face, some of those are potentially mitigated by AI. We talked about inflation recently, and AI has the potential to be a deflationary technology. If goods and services can be produced more cheaply as a result of AI, that eventually passes through the consumer, and prices actually go down. And so we love.
I think a good example of that is like the big screen, the flat screen TV, right? When that technology rolled out 25 years ago, you'd spend $10,000 for a big TV. And today you can spend $500 for the exact same television. Well, not significantly better television today. And some things become deflationary with the improvement of technology.
Absolutely. Yeah. And AI has the potential to do that in spades, both from a, more efficient manufacturing and logistics and distribution and elimination of, costly, kind of, white collar, jobs, that type of thing. There's a lot of opportunity there. And for what's called creative destruction, where it will kind of eliminate some things and there's pain associated with that, but then provide new opportunities that are perhaps even better. So we're pretty bullish on AI. That's not to say it won't have its bumps, just like the internet had its bumps, right?
Sure. Yeah.
The internet got way out over its skis from a market pricing perspective, and that was painful for investors. But as far as the technology being transformational, it absolutely did that, and we kind of feel like AI has the potential to do the same thing.
Yeah, I love the comparison to other major historical shifts like railroads, because the technology didn't exist 200 years ago to be able to ship goods, materials into certain areas in any kind of efficient manner. So expansion, just, you couldn't do it, right?
Yeah.
And then once the railroad was completed, all of a sudden we could move people, we can move goods, we could expand, and it opened up a whole new world that didn't exist prior to that technology, if you want to refer to a railroad as technology.
Yeah.
But that's kind of what we might be looking at. And I think other businesses are seeing this. So there's a lot of money being invested in this space today, because I think other people are recognizing the opportunities. Scott, walk us through what this graph is showing.
Yeah, so this chart shows sharp increases up and to the right. So anytime we see a chart like this, it says, hey, whatever we're looking at here is experiencing rapid growth. And what this chart is showing is the expenditures on a quarterly basis by the big players in technology. That's going to be Meta or Facebook, Google, Microsoft, and Amazon. And they're spending north of $100 billion a quarter on kind of capital expenditure. This is things like data centers. This is things like, development of, models, et cetera. But they're spending about $100 billion plus a quarter. And there's estimates that they might spend $700 billion this year on kind of capital expenditures across this space. So that's a lot of money being invested, and that creates jobs. That does a lot of other things that are potentially beneficial from an economic perspective, not just from the technology from by itself, but the construction and everything else that needs to happen to support this boom.
And we don't have a lot of time left, Scott. There's two really good points I'd like to tie back into this. One, a significant demographic shift that's happening today. And then two, debt. Now, how do you see AI having an impact on, and we don't even use the word crisis, but if we're being honest with ourselves, that demographic shift could almost be categorized as a forthcoming pending crisis. Yeah. How do you see AI helping in these two spaces?
Yeah, and maybe to begin with that, a crisis, is, a strong term, but we are in a dire situation as far as what we're looking at from the demographic perspective, where there's far fewer people entering the workforce than are leaving the workforce. So we have a net migration out of the workforce. And then the other thing we see is $39 trillion of debt and counting. And both political parties aren't showing a willingness to really rein in spending. And year in and year out, we're running $2+ trillion deficits year in and year out.
And it's not just us.
Oh, no. And some of the demographic challenges we face are even more severe in other countries. Western Europe has just tremendous demographic challenges. Countries like Japan have really significant demographic challenges. And so this isn't endemic or unique to the US, but our hope would be that transformational technologies like AI provide productivity gains such that we're able to do a lot of growing our way out of this debt and demographic problem. To the extent we can get more productivity through AI, that is more output per worker, that's going to be helpful in kind of growing our way out of this problem. And just maybe like a homespun example, if you had a household making $80,000 a year between the two spouses, and they had $40,000 in credit card debt, that's not a great spot to be in. And you could even say, hey, that's kind of a crisis for them. But if all of a sudden they upskill and their income goes up significantly, and between the two of them, they're now making $200,000 a year, the debt burden is the same, but their capacity to pay and the size of it relative to their income goes down quite a bit. And so if we can see really robust economic growth and largely grow ourselves out of this debt problem, that is the Goldilocks outcome. That's the ideal that we'd like to see, because the alternatives aren't attractive. The alternatives are inflating ourselves out of the problem, which is obviously bad. The other one's austerity, where we tax more and spend less, which doesn't seem, likely from a political standpoint. So we really hope to see through AI and other innovations to really see some economic growth, because I think that helps solve the problem that's kind of staring us in the face over the coming years.
Yeah, and I'm going to take your analogy and make it really hit home hard. Are you ready? It's the household making $80,000 with the parents, the two spouses, and then you've got your 22-year-old kid still living at home, and mom and dad want to retire, but the 22-year-old kid isn't interested in entering the workforce. Now we've really got a problem unless we've got some major productivity gains somewhere else.
Absolutely.
And that's kind of one of the demographic shifts we're facing today is
yes.
the aging workforce. This baby boomer generation has been carrying so much of that workforce, and these younger generations are saying, we're not all that interested in doing a lot of the infrastructure work that you guys have built. So we got to have other ways of making up the productivity losses.
Yeah, no, the next decade will be super telling on that front. And so I'd just say on this, on this topic, Paul, I think people need to be cognizant. I think they need to be aware of it. I think they need to be kind of cautious with sensationalism around it, because this is a trend that we're seeing. This isn't necessarily, hey, this is going to happen tomorrow. But as good investment advisors, we want to keep an eye on those trends and prepare accordingly.
So Scott, in closing it all up now, when you step back and look at everything we've discussed, geopolitics, elections, the economy, long-term trends, what are some of the biggest takeaways for investors right now?
Yeah, sometimes the most important thing to do is be measured. It's so tempting to feel like, hey, I need to do something, because in a lot of areas of life, when problems arise or chaos arise, the solution to that is rolling up your sleeves and making changes and doing something different. Investing is not like that. A lot of times kind of reactive actions often do more harm than good. And so provided that one is well diversified, has some non-correlated assets in their portfolio, they're in the right lane from a risk perspective, and they have sufficient funds to cover their liquidity needs, we view this as a time where being patient and kind of standing pat in most cases is the appropriate response, because the outcomes are varied right now. We could have a scenario where the war is escalatory from here. And so if someone gets out over their skis with being too optimistic, they could get burned. Conversely, if someone says, hey, I don't like this, I'm going to head for the hills and get very conservative, we could have something happen as far as, a settlement or peace that would lead to really high market growth. And you don't want to miss out on that either. And so being measured right now, I think is as important as it ever is.
But Scott, that's not entertaining. We demand more sensational answers. No, I think your point is so important here. And that is, it's really easy to get caught up in entertainment. And that's the stuff you're going to get, on the radio that says, hey, if you don't pay attention to me, I lose money in advertising. Right. You get these in the news channels. If you don't pay attention to me, I lose money in advertising. And sometimes the right answer is to be far more measured and more disciplined and less sensational in the way we handle some of these headlines that we're up against, some of the problems that we face. And so I think that's probably my biggest takeaway. And I know that's not, I'm sensitive to our audience who listens to these. They say, give us something more exciting than that. I know that's not their favorite thing, but it's the right thing. And so, as investment advisors, our job is to give you the correct advice. As fiduciaries, our job is to train our clients to respond correctly. And that is the correct advice today is everyone's, you build a portfolio to be all weather, and that's where we want everyone to be. So, well, very good, Scott. I think we've gone up against our window here. Thank you, as always. Very helpful and helping bring in clarity to this kind of noisy environment. And thanks to everyone for joining us today on this call. And until next month's Market Minute, appreciate you guys. Take care.
Thanks, everyone.